So thank you for this wonderful opportunity to present our work. This is joint work with Ivan Marinovich and Kevin Smith. Kevin, I believe, is in the audience. So if you have any difficult questions, they go to him. So the paper's titled Disclosing to Inform Traders, and we kind of were motivated by the observation that prices reflect information from a bunch of different sources, right? So in particular, something that we've all looked at is private information that investors have. And so prices are, aggregating this type of information. But prices also reflect kind of strategic disclosures by firms, right? So firms are an important source of information in financial markets. The existing kind of theoretical literature tends to emphasize one dimension, but kind of misses on the interaction, right? So in particular, there are huge literatures that look at how do prices aggregate information across investors. There's also very big literature on disclosure models that look at how firms will strategically disclose information, but each kind of literature kind of takes the other side in a very stylized, simplified way. And so we kind of don't get great answers to questions like, how do these strategic disclosures depend on the information that investors have, right? And when there is this interaction, how well are prices aggregating information about fundamentals? And obviously, from an empirical or policy perspective, these questions are very important. So what do? We're going to do the most natural thing, which is come up with a model of strategic voluntary disclosure in a setting with privately informed CARA investors, right? And given where we're at and kind of what's missing, this seems like a very natural benchmark to start with. What we're going to show is that, perhaps not surprisingly, but in reassuring in a good way, the equilibrium is going to feature kind of a threshold type equilibrium, which is familiar to all of us from disclosure models, where firms will disclose information that's sufficiently good and not disclose information that's bad. However, because of this interaction, we get a few kind of interesting, potentially more surprising results, right? So the first result that I want to emphasize is more public information, more ex-ante public information can actually crowd in more voluntary disclosure, right? And this is very different from the implications of standard disclosure models. And it's particularly important for regulatory policy, right? If you're thinking about evaluating mandatory disclosures, this is a potentially important result. The second kind of interesting observation is that in this model, the price is either going to be on average higher or lower than expected cash flows, right? So firms are going to be generically, quote unquote, misvalued and in a systematic way. So what we'll show is that in a rational expectations type setting where every investor is conditioning on information efficiently, we're going to see undervaluation. In a setting where investors have kind of difference of opinions, and so they dismiss the information and prices, we can actually generate overvaluation in some cases, right? And again, this is important from an empirical perspective because what this suggests is that standard measures of mispricing that we usually interpret as biases or frictions may arise kind of naturally in sort of equilibrium. Okay, there's a big set of literatures that we're trying to contribute to. In the interest of time, I'm going to skip this. The one thing I do want to point out is we're going to kind of build on some recent literature on nonlinear rational expectations equilibria, and in particular, a paper by my colleague, Braden Briandrich. So I'll point that out in just a few slides. Okay. The first part of the model setup is very, very standard, right? So we're in a world where there's two assets. The risk-free asset is the numeraire. The risky asset pays off a normally distributed payoff. The aggregate supply of the asset, we're initially in our benchmark model, we're going to assume is 0. And I'll come back to this assumption. There's going to be 2 groups of traders. There's kind of noise traders that prevent the price from becoming fully revealing. And then there's going to be a continuum of informed traders. Each of them gets a conditionally independent signal, and they're going to maximize car utility, and they have risk tolerance tau. Right. So if I stopped at this slide, this is, the setup for a big chunk of the noisy REE literature. It's very, very standard, and things are, set up that way. I'm going to make a slight tweak that lets me generalize this model in a very convenient way, right? So this is a trick that I used in my job market paper a few years ago, at this point, many years ago. But the idea is I'm going to allow investors to have subjective beliefs about other people's signals, right? So in particular, Lian has the right beliefs about his private information, but he thinks my private signal is less informative than it actually is, right? And that's going to be parameterized by this parameter rho. In the rational expectations benchmark, rho is equal to 1, and so Lian has the right beliefs about my signal. In the other extreme, in the difference of opinions benchmark, this rho parameter is equal to 0. And in that case, Lian thinks Snehal's signal is just noise. It's irrelevant, right? And so what this lets us do in a very kind of tractable way is compare these 2 benchmarks and a continuum of intermediate cases where, by capturing this kind of subjective belief about others' information, this will end up in impacting what investors think about the informativeness of prices, right? How informative prices are. So when rho is equal to 1, investors are going to correctly condition on prices. When rho is equal to 0, we're at the other extreme where investors kind of completely dismiss this information. And then for intermediate rho, we're going to be somewhere in between. Okay. The third part of the model, the third ingredient, is the firm's disclosure decision, and that's fairly standard, right? The manager in the firm, before trading begins, is going to observe the payoff, and she can pay a cost C to verifiably disclose this information, right? And in the benchmark model, we're going to assume that the manager is commonly known to be informed. So we're in the classical Verrecchia version of these disclosure models. In an extension, we will look at the case where the manager is informed with some probability, right? And the uninformed manager cannot credibly commit that she's not informed. And so that's kind of the die variant of the model. And it turns out that variant of the model is a little bit trickier. I don't know if I'll have time to talk about it, but we do look at it in the extension. And so the manager is going to decide whether or not to disclose her information to maximize the price next period net of costs, right? And so here's the timeline. We've got that the manager observes B, chooses whether or not to disclose. Depending on the decision, investors will observe their private signals. They'll submit a demand that can depend on their private signals, the price, and the disclosed, whether or not there was a disclosure. If there is a disclosure, the price is going to be given by PD. If there's no disclosure, it's PND. And then in the final period, the firm pays off V. So again, the ingredients are not very surprising. It's a very standard setting. We're going to look for an equilibrium of the traditional form, which is that the firm's going to disclose if and only if the payoff is higher than some threshold T. Conditional on disclosure, because the manager's information is better than the investors, the price is just going to be given by the payoff. Conditional on no disclosure, investors are going to trade based on the information that's available to them, right? So that's private information, the price, and the fact that the payoff must be lower than the threshold. Now, the reason it's been hard to look at this model is kind of the technical problem that we're faced with now, right? Given that there's no disclosure, the payoff is a truncated normally distributed signal, right? So it's V conditional on the fact that V is less than a threshold. And so our standard techniques of applying kind of linear normal, methods doesn't work anymore, right? And so, what we do in the paper, part of the contribution of the paper is to kind of build on the approach in Briandrich 2015 to sort of conjecture and verify that there's actually a generalized linear equilibrium in this case. And what do I mean by a generalized linear equilibrium? What we're able to show is the following. Conditional on no disclosure, the equilibrium price is a function, a nonlinear function, G, of a linear function about payoffs, right? In particular, the linear function is the average signal plus kind of the traditional coefficient times the noise trade. And this function G it's nonlinear, but it's increasing and concave. And the fact that it's monotonic means that investors can now invert the function to back out a linear signal about payoffs, right? So this is kind of the idea isn't ours. This is something that Braden was able to come up with in his job market paper, but we're kind of extending that idea to show that even though the price is nonlinear function of the underlying information, you can actually invert it appropriately to keep kind of updating tractable. And there's a kind of a nice representation, which is that you can think of this non-disclosure price as the conditional expected value of a marginal investor. And marginal in the sense that this investor's private signal contains the same information that one would be able to infer from the price, right? So if you think about the guy who's in the market and they're kind of right in the middle, their private signal is exactly the same as the information in the price, they're going to be just indifferent between buying and selling shares. So in some sense, their valuation should be the price, right? And that's the sense in which the price reflects this marginal investor. I'll come back to this point in hopefully a few minutes. Okay, so that's kind of the characterization of the financial market equilibrium given no disclosure. Once we have this object characterized, we can then take a step back and show that there exists a unique threshold equilibrium where the manager will disclose if and only if the value is higher than the threshold. The threshold itself is characterized by kind of a very standard indifference condition, right? If you don't disclose, then the manager anticipates getting the expected non-disclosure price. If you do disclose, you get the true value, T, but you have to pay the cost, right? And the indifference condition basically sets those two equal, and you want to identify the T that sets these two things equal. Now, it turns out that even though this looks very standard, there's a little bit of subtlety involved in our setting. And the reason for that is in sort of standard disclosure models, conditional on no disclosure, the price that you're going to get doesn't really depend on your true type, right? And so in some sense, this left-hand side of this equation is kind of constant. It's just a function of the distribution. In our setting, because investors are privately informed, this thing endogenously depends on your true value. And so in order to make sure that we can, in order to ensure existence and uniqueness, we need to make sure that this non-disclosure price is not too sensitive to the underlying information of investors. Turns out that that's not a problem in our benchmark setting. In the Verrecchia version of the model, we can show that this is always true, but this is an additional wrinkle that can actually mess things up in the DI version. So I'm not sure if I'll get time to talk about it, but that's kind of what causes potential non-existence in the DI version of the model. Okay, so let me kind of, in the last few minutes that I have, talk about implications. First question that we wanted to ask is, what is the impact of public information, ex-ante public information on voluntary disclosure? And the standard intuition for this is that, if there's more public information up front, that's going to crowd out voluntary disclosure, because this public information means that conditional on not disclosing, the price is still pretty good, right? There's still a lot of information there. And so the manager says, well, I'm not going to bother paying the cost of disclosure. The price is close enough to what it should be, and so I won't disclose, right? So better public information, better ex-ante public information will crowd out disclosure. And this is something that regulators and firms always use as an argument against increases in mandatory disclosure, right? In our setting, there's kind of an offsetting effect, which is that more public information ex ante implies that investors put less weight on their private signals, right? Because you're Bayesian, and so you're going to put less weight on your private information, but that can actually end up meaning that the price in equilibrium, conditional on non-disclosure, is less informative. And now the manager has a stronger incentive to disclose, right? So obviously, these two things are kind of competing. On the one hand, you have better public information, but on the other hand, because of this kind of secondary channel, you have less private information getting impounded into prices. And what we can show is that when the private information, when the private signals are sufficiently precise, then this secondary effect can dominate, right? And so this is one of the results of the paper. When disclosure is sufficiently costly, and private signals are sufficiently precise relative to public information or priors, then ex-ante public information can crowd in more voluntary disclosure. And we think this is kind of an important result when we're thinking of regulatory decisions about whether or not we should increase mandatory disclosure. In particular, the improvement in disclosure, this kind of crowding in effect, is most relevant for firms that have ex-ante worse information environments to begin with, right? Where disclosure is costly, when public information is not so good. And so in some sense, this sort of mandatory disclosure is actually good for the firms that need it the most, right?
The second 3 minutes.
Yeah, great. So the second result that I want to focus on is, how well do prices reflect fundamentals? And the standard intuition in these settings is that when the aggregate supply is zero, right? We've assumed in our benchmark the aggregate supply is zero, there's no risk premium effect. And so prices on average should be equal to expected cash flows. This is definitely true in disclosure models where the price is usually just the conditional value given no disclosure. And so that's usually the case. In the real world, obviously there are risk premia, and we have an extension where we account for this, but think of this argument as applying to risk-adjusted prices, right? So risk-adjusted prices should reflect expected cash flows. And so in this setting, mispricing is usually interpreted as evidence of a bias, a behavioral bias, or some kind of friction. And what we're going to try to argue is that that's not necessarily the case. Right? So in particular, in our setting, conditional on no disclosure, the average price systematically deviates from expected cash flows. Specifically with rational expectations, we're always going to have undervaluation. And with difference of opinions, we can show that when investors are ignoring price information, we can have overvaluation when the volatility of noise trading is sufficiently low. And we can have undervaluation when the volatility of noise trading is high, right? And these results on conditional expected values will translate into unconditional misvaluation because conditional on disclosure prices are correct. And so on average, we're going to get these effects. Now, I don't think I have time to explain the intuition, but let me tell you a little bit about the implications of this. So the first implication is that average pricing errors can be larger even when all investors are correctly incorporating the information in prices, right, under rational expectations. So that's kind of a surprising result. And what that suggests is you have to be careful when empirically using these measures in trying to infer how well are investors in processing information. Second, firms may have a lower cost of capital when they don't disclose. This shows up in the difference of opinions model because there's overvaluation conditional on no disclosure. And third, we show that there's actually a negative relation between average returns and skewness in the rational expectations world. And this is interesting because usually to explain this effect, we have to assume something like non-standard preferences, right? Like investors have a preference for like lottery-like stocks. But what we show is that this can arise endogenously in a rational expectations model. So very briefly, I've kind of alluded to these extensions. We look at the die extension where there's some probability that the manager is informed. There's some wrinkles there, but one kind of interesting takeaway in that setting is that you can get both under and overvaluation in a rational expectations equilibrium, so you don't need to go to difference of opinions. We also look at the case where there's a positive aggregate supply, and what that does is it just changes, it shifts the threshold, okay? I'm happy to chat more offline about the extensions. So just to kind of conclude, we develop a model with voluntary disclosure where investors are risk averse and privately informed. This interaction between the private information of investors, how they perceive price information, and the voluntary disclosure by firms, these three kind of ingredients interact in some interesting ways and sort of uncover some new economic channels. So, public information can crowd in voluntary disclosure. We show that there can be under or overvaluation relative to what we think of as expected cash flows. And we think that there's this negative relation between expected returns and skewness. We view this paper as kind of a benchmark paper, right? Like we're hoping, all of you will think this is interesting and build on extensions. There's obvious opportunities for future work. Endogenizing information acquisition by managers and investors. You could think of dynamic disclosure decisions. That would be interesting to look at. And then finally, in a bigger picture sense, thinking about investment decisions by managers and disclosure decisions jointly. So in a model with potentially like feedback effects, that would be interesting. Thank you so much. And I'm looking forward to Dima's comments.
Thank you, Snehal, for an excellent presentation. So the discussant is Dmitry Orlov from University of Wisconsin Medicine. So Dmitry, the screen is yours.
Thank you very much. Snehal, thank you for great presentation. Also, thank you for previewing a to-do list for yourself or for everyone else in the audience. It's really limits how much I can say on my slides. I have some overlap, but and thank you very much for organizing and having inviting me to discuss this paper. This is written by Snehal, Ivan, who I know from Stanford, and Kevin, who I do not. But anyways, the paper was a pleasure to read, plain and simple. You read this and it's like kind of like it's written almost like a textbook in terms of the level of exposition. It's one of the more polished papers that I've read over the last couple of years. And whenever you get to referee a paper, you're like, well, I wish more papers were like this, I think. Now let's talk about kind of the substance of what the paper does. Well, it attacks like an absolutely fundamental question of how do markets become informationally efficient, right? So it's an age-old question. And if you think about it, there is like, and maybe the social media part is like the fourth one, but I think about this, or at least in context of this paper, is there are regulatory disclosures. In this paper, they're defined by the ex-ante uncertainty there is about the firm, but you can think about them as some kind of regulatory requirements on firms that affect how kind of dispersed our initial prior is about the firm's cash flows. Then there's voluntary disclosure, a massive literature in the intersection of accounting, economics, and finance. And voluntary disclosure is basically managers will disclose what they would like to disclose. So if it makes their compensation or their options more valuable, they'll disclose they'll disclose this information, or they will hold it otherwise. The standard result in this literature is managers will disclose good news and hide some bad news, and that's kind of the benchmark that you're safe to assume for the majority of this paper. And then there is informed trading, which is very much related to the paper that Lian presented earlier, in that there is a dispersed amount of information available in the market, and it goes into prices via some kind of market mechanism. In this case, it's a nonlinear rational expectations equilibrium. Now, the complexity of the question analyzed, and why Snehal alluded that this is really should be viewed as a framework, is that all of these three channels interact with each other. So regulatory disclosure affects voluntary disclosure and affects informed trading, voluntary disclosure affects informed trading, and vice versa. And so there's like these three-way interactions that go on, and it's a hard thing to track. And what the paper does absolutely, in my opinion, masterfully, is it's able to characterize things kind of in a way that's tractable, and where you can kind of track the effects of each of these kind of interactions and what implications they have on prices. And to my knowledge, this is kind of the first paper of its kind, and I think it should receive full credit for it. Now, if you think about the model, it's kind of a very classic, if you will, model. It kind of looks like you would expect it to. There is the regulatory disclosure stage, which is basically, in the model, it's not called regulatory disclosure, but some of the comparative statics that Snehal showed could be interpreted from the perspective of basically how much the firm was required to disclose initially. And then there's voluntary disclosure, which again looks a lot like the voluntary disclosure that we would expect, that the manager will disclose good news because it increases his compensation, career prospects, things like that. Now, here's where the caveat kicks in. If there is no disclosure, then the market is the one that's determining how much of this information is going to enter into prices. So investors trade. The manager then expects this trade to occur, and that has a marginal implication on the particular disclosure threshold that the manager will choose. And if you think about it kind of very parsimoniously, suppose that the market is completely informed. Well, if the market is completely informed, then the manager can save the cost and not disclose anything, because you save a little bit of disclosure cost, and then all the information gets incorporated into prices anyways. While if the market is not informed, then you may have a slightly different calculation. Now, in this nonlinear REE, I think the paper presents a very clever and novel, to my knowledge, application of the techniques developed by Braden Briandrish in his job market paper. And Braden's paper was kind of, in my understanding, more methodological, but this is a very applied kind of interpretation and usage of those techniques. And I'm not going to go over them. Instead, I'm just going to go straight to kind of the main implication that Snehal talked about. One of them. So crowding in versus crowding out. I always, because I'm Russian and not a native English speaker, I always get confused what's crowding in, what's crowding out. So instead, I'll just talk about more regulatory disclosure prompts, more voluntary disclosure, and vice versa. So if we basically ignore trading, if there was no informed trading in the model, then kind of a standard disclosure argument would tell you that if there is we live in a world where there's a lot of regulatory disclosure, and we reduce it a little bit, then you will have more voluntary disclosure. And the reason is, kind of going back here, is that when there is less regulatory disclosure, so that means that the left tail of firm values is quite thick, which kind of hurts the manager that's right at the cutoff. So if there is a lot of imprecision in public news, then the manager is going to be more likely to disclose, and that's this mechanism where if you want the manager to disclose more, you want less regulatory disclosure, if you will. So that's kind of the standard result. Now, if you have informed trading, then you kind of have to account for how regulatory disclosure affects incentives to trade. And in that case, more regulatory disclosure actually prompts more voluntary disclosure as well, because regulatory disclosure crowds out informed trading, if you will. There is less basically uncertainty in prices, so there is less kind of a kick from informed traders. And this is where I thought it was kind of an interesting channel, where we kind of have to think about how regulatory disclosure affects informed trading as well, to look at kind of the combination of the two and what they do to the left tail of the distribution that the manager ultimately cares about. And I was wondering if there is a way to basically like present a benchmark in that, in the absence of the manager voluntary disclosing, whether regulatory disclosure has kind of a monotone effect on the total information available coming from kind of regulatory disclosures and the rational expectations equilibrium. Because I'm not sure if they're one for one. It's a I mean, without the voluntary disclosure, it would be a linear equilibrium, something easy to do, and just to understand whether it's kind of whether there is a monotonic relationship or not. It's something just purely for exposition. Now, however, looking at this, I was then kind of comparing this plot, which talks about regulatory disclosure, with a plot that's in fact right next to in the paper, which talks about informed traders. Is it better or worse in some sense to have more informed traders out there? And here's why I think that, here's how I think the 2 points are related. Information goes, so prior to the manager disclosing, information gets incorporated into prices also through trading to some extent. Now, there is no trading period before the disclosure stage in the current paper. But if you think about kind of this plot, what happens is that if there is better informed traders, then it's basically crowding out voluntary disclosure. Basically, if everyone is perfectly informed, all the traders are perfectly informed, the manager can save the cost of disclosure. Now, if, however, there is no informed trader, so we're in the right corner over here, then the manager discloses everything. And the reason is that in the absence of kind of efficient, informationally efficient markets, the manager is basically facing such a big left tail in his disclosure decision that the difference between basically the average outcome below particular valuation and that valuation always exceeds the disclosure cost. In other words, it leads to unraveling, if you will. So something that can happen in a Berecchia style disclosure model. So this kind of picture, I would like to get a little bit more context on potentially from the authors, in the sense that what if there was a similar trading period before a voluntary disclosure phase? Because if that was the case, then this informed trading would look more like regulatory disclosure, more like affecting the prior of the manager prior to the decision. So just kind of getting a sense of what that comparative static would look like, more like a robustness check of anything. Because right now, kind of the paper doesn't spend much time on the spot. I think there is more to it potentially, just because there is kind of substitution that we can also get from between regulatory disclosure and REE. Now, and finally, again, like it took me actually to write this slide to notice that as we remove informed traders from the picture completely, then we get full informational efficiency. And this is kind of an interesting observation, that without financial markets, you can get perfect transparency. Again, it's not an issue with this paper, because it's just a consequence of the costly disclosure Berecchia style model. But it would be interesting, at least from the for the readers, to provide sufficient conditions when informed traders are incrementally valuable for informational efficiency. I'm not saying that it's a very kind of minor point to make, but I think that it would kind of help to explain why we sometimes end up with basically full transparency without any informed trading, and vice versa. So, and from here, from here, I'm going to make two more points before concluding. I think I have a couple minutes. So the model, the analysis, and the results are written exceptionally well. Like the paper is very clear what it does. It tries to, and I think it successfully ties the empirical structure, the theoretical results to the empirical kind of counterparts. But then during these interpretations, two things caught my attention a little bit. And that if the paper is tackling empirical kind of patterns seriously, which it makes a serious attempt to do, then maybe spending a little bit more time on this extension with positive net supply would be beneficial to kind of to kind of a more representative, kind of more broader contingent of the profession. Because again, I think that this fact that the firm is in zero net supply in the paper shows the kind of the experience of the authors, because it really makes the kind of the results very crisp. And I appreciate that, because, you know, thinking about under and over valuation, it's very clear. But then when we think about kind of under over valuation and their interactions with risk premium, something that you would observe if you were to test this, then I think it would really help to kind of fish this out. And I think that it would be just useful to do numerics in the main paper for illustration purposes. It seems like something the authors have already done, but right now it's not, it's at least not in the main text. Because at the end of the day, there's a lot of skewness in the paper. It's all about kind of the left tails, and how risk premium interacts with disclosure could be of separate interest. I don't think that, you know, the authors need to rewrite anything already in the paper, but provide a little bit more discussion how it changes the under over valuation results. And another thing that, again, reading this paper, I kind of started thinking about is that there is, because of the zero net supply, the discussion goes around the fact that the value of the firm is idiosyncratic information. And that made me think, well, you know, systematic versus idiosyncratic information and firm risk, it's absolutely novel in the context of the disclosure literature, because most of the disclosure, if not all disclosure papers are in the risk neutral world. However, it would tie so very well with a rational expectations equilibrium, where we kind of think about systematic versus firm specific information. And you have specialization. So traders may care more about systematic components, while the manager may choose to disclose the idiosyncratic component. And this just is, I think, in itself a novel question that the disclosure literature could start asking in this framework. So I think that this kind of mention of the firm value being idiosyncratic component, I think it's just kind of a rabbit hole to pursue, specifically how to differentiate what the managers disclose. So for example, if there is voluntary disclosure, would it tend to carry aggregate information, or would managers prefer to focus on firm specific information? Again, I think the discussion in the paper basically led me exactly to thinking about these questions. It's not something that I've seen being addressed in the literature, whether, you know, the authors or the audience or whoever reads this tackles this, but I think this would be very promising and could be a big question to ask going forward. Whether, for example, they will tend to kind of separate into different bins. Someone would, so manager would prefer to focus on a specific information. Traders care about systematic one. Maybe, don't know. And this is kind of my takeaway. I think the paper is great. I don't think when I'm writing this discussion, I didn't want to send a message to anyone, including the audience, that the paper needs kind of big changes to be, from my perspective, successful. I think it achieves a very nice balance between being clear, novel, and applied. It has also kind of deeper theoretical points, for example, on the non-existence of threshold equilibria, which I think kind of, to a theorist like me, I thought that was cool. But again, like, there's a balance. There's something for everyone in the paper. And now, kind of to Snehal's to-do list that he kind of concluded with as well, I'll also mention. Well, you know, one of the things that one could ask in this framework, and that's kind of on the almost at the kind of the top of the iceberg, is costly information acquisition by the agent and the traders. Because if you kind of think that there is some crowding out going on, crowding in or crowding out, one of those, then it could affect the incentives to acquire information. And this is something, of course, that the authors have worked on before. So this is not something that I'm sure it's not new to them. However, then I was thinking, well, from a regulatory perspective, this is also a nice framework, because suppose that you are a regulator trying to elicit valuable disclosure of information from the firm. Well, what kind of information would you like them to disclose? Well, if you take the voluntary disclosure stance and you care about informational efficiency, you want the firm just to disclose bad news. you don't care about disclosure of good news because the manager is going to do that anyways. And so if we think about the design of regulatory disclosure, basically what information because you can have nonlinearities at the first stage as well, potentially. The paper could handle that. And this is another place where, because the model features informed trading and voluntary disclosure, I think it could present kind of some, maybe even some policy recommendations that could be taken more seriously than a model without either of those elements. And so these are my points. And again, like I thought it was an awesome paper. I've very much enjoyed reading it. And in some sense, it was a hard discussion to prepare for, just because there's not obvious kind of things where I can, which I can hammer away. So instead, I'm kind of giving my suggestions and some interpretations. I think it kind of opens up for more subsequent work, in my opinion. Thank you very much.